In this video for Chapter 9, we'll be talking about credits, tax credits. And the way they have this laid out in the text is we kind of provide an overview of each credit, so we'll kind of be moving along kind of in a disjointed way from one credit to another. They're all different, they're calculated differently, they have different phase-out amounts. Some are refundable, some are not. So we'll have to kind of study each of these tax credits independently of the others, because they are independent, of course. All right, so learning objective number 1, credit for child and dependent care expenses. So this is the first credit that we talk about, and this is a credit that is available to folks who are working, taxpayers who are working, and have dependent care expenses that are not reimbursed. So the test for who qualifies as a dependent to be cared for is any person under the age of 13 or someone who is any age and cannot take care of themselves, is incapable of doing so. So the credit then that's allowed is calculated as a percentage of the qualifying expenses incurred on reimbursed expenses times certain percentages, which range from 20% on the low end for higher income earning folks to 35% on the higher end for low income earning people, taxpayers. So the amount of expenses that can be used for the calculation is limited to $3,000 for a qualifying individual, and then $6,000 for 2 or more qualifying individuals. Then there is another limitation, and that is a limitation which we'll talk about regarding whether or not there is someone else available to take care of the kids, for example, another spouse. So if we have a spouse who is incapable of caring for oneself, or a full-time student, this non-working spouse is treated as having earned $250 per month, because the assumption is they'd be getting some type of benefit, Social Security benefit, very likely. This doubles for 2 or more such qualifying persons. In the case of a student, however, only the months he or she is attending school can be used, because again it's presumed that when this person is not in school and is obviously not working, they'd be available to care for either themselves or other dependents in the home. So the next credit that we'll talk about is the credit for elderly or disabled. And in the video I'll be providing that demonstrates some of the problems. We'll go through some of these credits and how to calculate them. Well, this credit is for those who are over 65 or permanently and totally disabled. And we'll talk about the 15% of the allowable base, and we'll calculate that in the succeeding video regarding problem demonstrations. And as many of these credits are, it depends upon the filing status. So if we drill a little bit deeper into the credit for elderly or disabled, I talked about the allowable base being different depending upon how you file. So for a single taxpayers, $5,000 is the allowable base. It goes up to $7,500 for joint. When both spouses qualify, down to $3,750 for a married person filing separately. However, these bases, can be reduced further by the amount of non-taxable Social Security received. Again, this is only the non-taxable Social Security received. And then 1/2 of the amount of AGI that exceeds an allowable base. And I'll go through again. The only way to really understand some of these convoluted qualifications for these credits is to demonstrate them in some problems I'll be going through in the next video. However, when we look, we see a base amount for Joe and Sue, who are married, filing a joint return. One is over 65, the other is not. AGI at $12,000, and they received non-taxable Social Security benefits of $1,500. So we're going to take out those non-taxable Social Security benefits from this $5,000 base amount. And then we're going to deduct half of the AGI over $10,000. And so half of the AGI over, we have $12,000, right? Minus the $10,000 base is $2,000. And then we'll take half of that, and that's $10,000. So that brings us down to an allowable base of $2,500, and therefore the credit for these taxpayers is $375. And I'll go through some of the percentage calculations earlier. Remember, this is the 15%, so we'd apply 15% against the $2,500 to get to $375. Okay, so let's move forward then to education credits. Again, now we're changing gears and talking about education credits. So there are two: American Opportunity Tax Credit, AOTC, and then the Lifetime Learning Credit. Some of you folks who have taken this credit in the past may know it as the Hope Scholarship Credit. They've made some amendments to it, made it more generous in terms of who qualifies. For example, under the old Hope Scholarship paradigm, they only allowed this credit only applied to the first 2 years of college. Now it applies to all 4 years. Lifetime Learning Credit applies to everybody else, but it's not quite as generous, as we'll see. Both of these credits would apply only to qualified educational expenses, and those are listed in the chapter, such as tuition and fees and things like that. So for the American Opportunity Tax Credit, it's calculated based on 100% of the first $2,000 of qualifying expenses that the student incurred, and then 25% of the next $2,000 of qualifying expenses, but it may not exceed $2,500 per student per year. So if there are several students, each student would qualify for potentially the maximum of $2,500 per student. Lifetime Learning Credit, as I said, is not quite as generous. It's only 20% of the qualifying expenses for a maximum of $2,000, but this is per taxpayer per year. That's a little bit different than per student per year, because you could have several students and they would all qualify for the $2,500. That per taxpayer means that even if you had several students taking the Lifetime Learning Credit, only the maximum of $2,000 total would be allowed under the Lifetime Learning Credit. And you may not double up. You may not use both of these credits in the same year. There is, like many of these credits, a phase out. As income rises, the availability to take this credit begins to diminish until it's eventually phased out completely when modified adjusted gross income for single people reach $90,000 and $108,000 for married filing joint. The Lifetime Learning Credit also has a phase out. However, as you'll notice, the amount is phased out completely at only $66,000 for single, $132,000 for married filing joint. So again, these Lifetime Learning Credit is just not as generous, and it phases out sooner than the American Opportunity Credit. So here's a look at that phase out process. When the modified adjusted gross income, or MAGI, is within the phase out range, the credit is reduced by multiplying the amount by this fraction, and that is $180,000 times minus the MAGI divided by the $20,000. And then for single taxpayers, it's $90,000 minus MAGI over $10,000. And the denominator happens to be the range, the phase out range in both cases. The Lifetime Learning Credit, as we said, is a little bit lower, easier to phase out of that one. And here the range is $20,000 until it's completely phased out. $10,000 is the range for single taxpayers. This credit is available for taxpayers who paid foreign income taxes. This is the foreign tax credit, sorry. The foreign tax credit is the next credit we'll talk about. And it's available to folks who will have paid income taxes to foreign countries. And one of the reasons this credit is available is that if someone is earning income, for example, in the United States, and they have to pay taxes to France, for example, and they're taxed again in the United States, then they'd be paying tax twice on the same earnings dollar. So for most countries, especially with those who have tax treaties with the United States, we have this, the U.S. has this tax credit that will help to mitigate the likelihood or reduce the likelihood of paying taxes twice on the same earnings. The credit is equal to the foreign taxes paid. It cannot exceed, however, the U.S. portion of the tax liability attributable to foreign income. So if some of your income is attributable to U.S. earnings, some to foreign, the credit cannot exceed the amount of the U.S. tax liability. This foreign tax credit, then, this is the calculation of the formula to calculate this foreign tax credit and its limitation. As I said earlier, you take the foreign sourced taxable income and divide it by the worldwide, that's everything that was earned by the taxpayer, U.S. and foreign. Then you multiply it by the ratio of U.S. income tax liability before before foreign tax, and that would be the U.S. income attributable to the foreign income, attributable to foreign tax, excuse me. So again, that is the foreign source income divided by the worldwide, that ratio, times the U.S. income tax liability. So another credit that's available, and many of you, I'm sure, are aware of this or have heard about this child tax credit. It's provided for taxpayers with children under 17. You have to be a U.S. citizen. Child must be younger than the person claiming the credit. Credit for each child is $1,000 and is phased out as AGI increases, and we talked about most of these credits being subject to phase-out limitations. This credit is a non-refundable credit, and when we mean by that, like most of these are, non-refundable credits mean that in the event that the credit creates a refund, then the credit is cut off where taxable income becomes zero. Is at zero? So that it cannot actually create a refund for you. So the most it would do in that case is to reduce your tax obligation to zero, if that were the case. Otherwise, it just reduces your taxable income. And you'd report this credit on Form 8812.